Well, we've had some pretty substantial recent developments in the real estate market lately. We've got a lot to talk about, so let's get into it. Hey, how you doing, guys? Derek here from M1 Realty. I'm the founder of the company, broker owner. We opened our doors here in 2014, and now we're the #1 real estate firm in the city of Ferndale, Michigan. I've got an all-star team of agents ready to help you whether you're looking to buy, sell, invest, rent, whatever you need, we got you covered. So the thing that everybody's been talking about lately is interest rates. Yes, they've gone up substantially since the last time I did one of these videos. And obviously nobody wants to pay a higher interest rate if they don't have to. So I'm not gonna sugarcoat it, we're gonna break it down. We're gonna show you exactly what's going on in the market right now and what that means for you, whether you're looking to buy or sell, or if you just wanna know what's going on in the market just to know. So I guess let's just start at the beginning, which for this video's purposes will be about 1 year ago. So a year ago today, interest rates for a 30-year fixed conventional mortgage was in the neighborhood of 3%. Some of the lenders I was working with were even offering mortgages in the 2s, which we'll get into that a little bit, but that was obviously those days were fantastic. That was driving a real estate boom that the likes of which we haven't really seen too many times in the past 100 years. But that was kind of artificial, and I'll explain why here in a minute. But that's where we were at. So today, as of just 20 minutes ago, today is the 27th of September 2022, the average fixed conventional 30-year mortgage is sitting at 6.72%. So we've more than doubled in the span of a year what our interest rate is. In fact, just yesterday on Monday, the interest rates came out at 6.5%. They're already up to 6.72. So that's a pretty substantial jump, obviously. And so what does that exactly mean for your buying power as a buyer, right? So let's back up for a second and talk about why this is all happening. So interest rates are going up. The reason why that's happening is it's a function of the Federal Reserve, and essentially their one tool to combat inflation is to control the interest rates. So since the inflation report came out last week and showed that the inflation rate was much higher than everybody thought it was going to be, they went and raised their rate 75 basis points, which in plain English is 0.75%. So essentially the mortgage market is tied to the rate that the Fed controls. So mortgage rates went up as a result as well. And actually they started going up before the Fed even met. That's usually what happens, is they'll go up in anticipation of the Fed raising rates. The Fed raises rates, everybody panics for a couple weeks, and then rates start trickling back down. I'm not so sure that's going to happen this time, because I don't think the Fed is done raising rates. In fact, they said they're not done raising rates. So let's talk about what that means from a real estate standpoint. What they're trying to accomplish by raising interest rates, which in turn raises mortgage rates, is to bring the price of homes down. Which, if you're looking to buy a house, that's fantastic. If you're looking to sell a house, obviously not so great. But in our market, I don't know that it's really gonna have that much impact, and I'll talk about why in a few minutes. But getting back to about a year ago when rates were in the 3s, at that point in time, they basically, the rates were real, obviously that's what it was, but I think they were being kind of kept artificially low in order to keep the economy churning along. It's all kind of like tied back to COVID. In an effort to really just jumpstart the economy once we got through like the worst part of COVID. Hopefully that was the worst part. But they wanted to get things kicking again and get things moving, and one of the ways that they did that was make the cost of borrowing money really, really low. And now we're kind of like seeing the inverse of that. And the reason, one of the downsides of that is runaway inflation, which is what they're trying to control now. The way to do that is to raise interest rates to a point where, they're getting to the point where they're going to be artificially high. But the reason that they're doing that is to slow the economy down, pull the reins back, kind of get things on an even keel, which, it sucks for me and it sucks for anybody looking to buy a house or borrow money or whatever. But I get why they're doing it. It is what it is, and we're all just going to have to deal with it till we get the inflation under control, get a handle on that. And I'm probably going to get myself in trouble for even saying this and jinx everybody, jinx the whole real estate market by saying this. But as of right now, we're still below the 40-year average mortgage rate, which is 7.17%. That's, over the last 40 years, that's been the average. We're at 6.72 as of today. Fingers crossed, knock on wood. Hopefully by tomorrow we're not over that point, but we're gonna see what happens. But as of right now, we're still, in the grand scheme of things, we've seen a huge jump in mortgage rates over the past year. It's just important to know that we're still, below average for the time that most of us watching this video have been in the real estate market looking to buy. There's not too many people that have been in the market longer than 40 years. Obviously, some of you have, and you'll remember the rates back in the 80s when they were, 16, 17, 18%. Hopefully, we're not going to get anywhere near that, but I think what they're doing right now is raising rates in order to so that we don't get to that point where they have to just go sky high on the interest rates just to really rein the inflation back in. And in all likelihood, what we're gonna see, over the course of the next year. I mean, I don't know for sure. We're just a lot of this is gonna have to do with where the inflation rate is, inflation index. And as long as that starts going down, I don't think we're going to see, these massive, 75 to 100 basis point jumps moving forward. But if we can't get a handle on it, we very well may see that moving forward. And, that's just going to keep rates going up and up and up. But, what if you have to buy a house now? What if you're in the market? What if you've got your pre-approval? What if you're looking to sell a house? What does that all mean for you? So let's talk about that for a minute. If you've had a pre-approval for a while and you are in the process of looking to buy a home, haven't got one under contract yet, I would definitely get with your loan officer and just get a handle on where, if you got approved 3 months ago and the interest rates were, 5% at that point, we need to know what your buying power is now, because it has changed. So, if you were approved for, $300,000 back then, you might be a $265,000 buyer now, just because so much more of that monthly payment is going to interest. So first things first, get with your loan officer, get a real good idea of, what your monthly payment's going to be, what your buying power is, and when I'm working with buyers, I don't like to, I don't worry about what the dollar amount is of the purchase so much. I worry about what monthly payment are you comfortable with, and let's just focus on that and keep you, we'll let that dictate what houses we look at and what prices we look at. So that's going to change. The more you're paying in interest means the less that goes towards principal, which means your overall buying power is coming down. So we just need to make sure that, the buying power that you have is, commensurate with the houses that you want to buy. So if you were just on the edge of being able to afford a certain subdivision or city or type of house or whatever the case may be, you might not be there now. So maybe the best idea for you at that point is to just, sit on the sidelines for a bit. I don't think that's the right answer, and I'll talk about why in a second. But it could be, and that's really a personal decision. It's up to you, and it's our job as agents to advocate for you to the best of our ability, depending on what you want to do, what the best outcome is for you. Not about nothing else really matters at that point except for making sure that we're helping you accomplish the real estate goals that you want to accomplish. One of those things that I look at, and I've been saying this I've been pretty consistent about this for months and months and months, is the inventory level that we have here in Metro Detroit is kind of driving the bus. That's really more important than almost any other factor. They would have to raise interest rates. Interest rates could double from where they are now, and obviously that would have an impact on home prices. That would kind of supersede supply and demand. But as of right now, we're not dealing with very much supply in the housing market. Builders have slowed down building quite a bit, and the actual inventory out there on the market is half of what it would be in a normal year. So, we still have lots of buyers out there looking. There's not that many houses for them to choose from. And if that stays the case, home prices are going to keep going up in our market. I mean, they can't, the Fed can't say, well, we're going to raise interest rates 75 basis points, except for Detroit because they have low inventory. So we're going to keep it the same there. It's national. So we're dealing with the same interest rates and market forces that any place else in the country is dealing with, but a lot of places around the country aren't dealing with the same low inventory that we are. So it is what it is, but I think that is a more important factor than the current mortgage rates personally. Like, for example, I always bring up Ferndale because I live in Ferndale. I've been in Ferndale 17 years. That's where our office is. Ferndale's only got 58 houses on the market right now, whereas in a typical year, even as we're getting kind of out of the peak selling season and kind of slowly getting towards the holidays here, we would still should be seeing closer to over 100 houses on the market, and we're roughly half of where we would be on our normal inventory. And likewise, Royal Oak's at 185 active listings. That's condos and single family homes, which is probably half of where they should be. I don't want to leave Macomb County out. St. Clair Shores right now has 92 single family homes. This time of year it's not uncommon for there to be 160 to 175 single family homes on the market in the Shores. So that kind of gives you an idea of where we're at in terms of inventory versus where we should be on inventory. If that was the case, if we had 175 houses on the market in St. Clair Shores, then we're definitely would be seeing the interest rates going up impact the prices. The prices would start coming down. But I would say there's probably more than 92 home buyers that are pre-approved looking for houses in St. Clair Shores right now. So when you've got more buyers and you do have houses to put them in, it's supply and demand. Prices are going to keep going up. And on top of that, across the MLS as a whole, so Oakland, Macomb, Wayne, Livingston, you name it, just the metro area in general, the entire MLS right now, there's a 2-month supply of homes on the market. And I personally don't call it a buyer's market until there's closer to 6 months worth of inventory on the market. So we're a long, long way from that. So even though interest rates have gone up and some of our buyer pool has dropped out, there's still not enough supply out there to put everybody into the homes that they want. So again, it's just supply and demand market fundamentals. When that happens, prices are going to keep going up. And for that reason, that's why I'm saying if you're thinking about buying a home this year, but you're not sure, hey, should I wait? Should I do something now? What should I do? If it's me, if I find a house that I like, I'm gonna buy that property, and here's why. Because just like what we talked about with supply and demand, when there's not that much supply, and who knows? I don't have a crystal ball. I'll be the first one to say I have no idea what the market's gonna look like in 3 months or 6 months or a year. But that being said, I am pretty confident that we're not gonna just all of a sudden get a bunch of supply out of thin air. It's the homes have to come from somewhere, and there's not really, builders aren't building. There's not really that much of a backlog of foreclosures, so that's not gonna just come in and save us and have all these houses all of a sudden hit the market through foreclosure. That's not really a thing right now. Short sales are non-existent because everybody's got equity in their homes. So until I don't know where the supply is going to come from that would change the market. So that being said, if we're anticipating prices continuing to go up, you're better off buying a house now than you are waiting 6 months or a year. You're going to end up paying more. On top of that, I'm almost positive interest rates are going to keep going up. So not only are you paying more for a home down the road, you're going to pay more in interest as well. So your monthly payment is going to go higher. Your buying power is going to be diminished, and maybe that puts you out of the your perfect dream home that you could have got now that you won't be able to get in 6 months or a year. And on top of that, again, the one thing that's constant in this business, real estate, is that it's constantly changing. So yes, we're seeing interest rates go up. Interest rates are probably going to keep going up, like I said. for the short to midterm future. It is what it is. Like I said, the Fed's got to get a handle on inflation before they can worry about anything else. But one thing I'm positive about is that interest rates will come back down. So that's where you hear the term, marry the house, date the rate. What that means is find the house that you like. Yeah, if you got to bite the bullet and pay a little bit higher interest rate for, a year or two, once those rates start coming back down, then you refinance, then you're in a lower payment. You've already built up some equity in your home, and then you just, you get the monthly payment that you want. So that's what that means, and that's, I think, really good advice, especially if you find the perfect house for you. It would be unfortunate not to be able to live where you want to live, simply because interest rates went up a little bit, when it's just going to be a temporary thing. Another option that is starting to come into play that you've always had as a buyer, but it just hasn't been practical or necessary recently for a long time actually, is buying down your interest rate. So it's called paying points. So, and that's going to vary depending on the lender, depending on how far you want to buy the rate down. But one of the tools that we have as a home buyer is seller concessions, and that's not going to be every transaction, but it's getting more and more prevalent. They kind of went away on a lot of transactions for a while. Back in the day, I did seller concessions on every deal because you could. Now we're starting to see them more often, and what that is the seller is taking a percentage of their net proceeds at closing and giving that back to the buyer to cover closing costs, cover down payment, or to buy down the interest rate. So, say you get $3,000 in the concessions from the seller, you can put that towards buying down your rate. So instead of a 6.72% rate, and I'm just spitballing here, I don't know, this is probably not an actual accurate number, but maybe you can get under 6 if you buy the rate down, by using those concessions. And who knows if that's the right number or not, but loan officers don't sit here and correct me too bad. I'm just kind of throwing an idea out, not exact numbers, but that's one of the options that you have, is to get a lower interest rate by buying that rate down. Now, the thing about that is that only makes sense if you plan on staying in the house for a certain amount of time. So if you're looking to buy a house and then you're going to sell it in 2 years, it might be better off for you to just pay the higher interest rate, because it takes a while for you to make that money back and recoup the money that you used to pay down the rate. But if you're going to live in a house for 10 years, then heck yeah, it makes a whole lot of sense to do that at this point. Although, again, it's a roll of the dice, because we don't know. Maybe interest rates are going to come down on their own sooner than we think, and you could have just refinanced. But it's one of those things where there's no certainties in life. But if that's one of your options available, and that's the best option at the time, it might make sense for you to take it. So if you're selling a home, what does that mean? As of right now, not a whole lot. I've noticed average days on market have gone up quite a bit. But like I said, we're not anywhere near, buyer's market territory. Average days on market, I think, across the cities that I track, which I always track 5 or 6 cities in Oakland County. I always track St. Clair Shores. I always track Macomb Township. None of those cities is over 13 days on the market on average for homes that are selling. And until we get to about 30 days on the market, we're not going to really see a whole lot of price reduction activity. We're seeing a few here and there, but that's more of you put a house on the market, you're not getting the activity that you want from buyers, so you just drop the price. So you do it proactively, rather than there's just too many houses on the market and you have to lower the price to compete. That's not really a scenario right now, but for the most part, what I've been seeing is homes are still selling for pretty close to asking price. I think we went from, in Oakland County, the cities that I track, we went from over 100% of asking price 2 months ago, and we're at 99.8% this month. So all that means is there's fewer houses that are getting into bidding wars, but there's still a good chunk of homes on the market that are getting into bidding wars, and the price is going up over asking. So the moral of the story is, if you're selling your home, Now is still a really good time to sell. I prefer to sell, if I'm gonna sell my house, I'm gonna do it when there's not a whole lot of competition, because I know I'm gonna get more for my home, rather than wait for, you know, more homes to hit the market. That seems kind of silly and self-defeating at that point. Now, if I'm looking to buy a house, like I said, if I find the right house and it's like, it's perfect, exactly what I want, I'm pulling the trigger on it. I am not waiting, because, you know, like I said, either prices will keep going up and or interest rates are going to keep going up, probably both, but not necessarily both, but, you know, we'll have to see. But, you know, you might end up a year from now finding that same house and it's going to cost you more to live there. So what would you rather do? You know, pay more or pay less for the same house? Plus, you've also waited a year where you could have been, you know, creating equity in that property and like paying yourself rent every month that you're not going to have that opportunity to do. So hope this helps, guys. You know, if you have any questions, please reach out. My direct line is 586-491-5622. You can also reach me at 248-561-6155, or shoot me an email, dwerenka@m1realty.net, or just leave a comment down below and I'll get back to you. And before I forget, I would greatly appreciate it if you'd like this video, subscribe to the channel, and most importantly, just share this out to anybody that you think would benefit from it. That just keeps me in front of people just like you who want up-to-date, accurate information about the Metro Detroit housing market. And until next time, thank you so much for watching, guys. I really appreciate making these videos for you. If I'm missing anything, if you have any questions, if there's a topic that you want me to cover, just reach out to me and I'll get to it, all right? Thanks a lot, guys. Talk soon. Have a great one.